Well, good morning, and thank you for joining our discussion Beyond COVID and Accelerated Economic Recovery. This session is part of our series that shares insights from leading scholars, entrepreneurs, executives, investors on the evolving economic and business environment in the United States. Again, today's session is sponsored by March Capital. Today, our guest is Dr. Jim Doti, President Emeritus and current economics faculty member at Chapman University. Jim will share with us why he believes the economy is more resilient than most people believe and share his forecast for a V-shaped recovery as highlighted in his economic forecast published earlier this week at Chapman University. We have a limited number of copies of that available. If you like one, please let us know. Under Jim's 25 years of leadership as president of Chapman University in Orange, California, from 1992 to 2017, Chapman was transformed into a highly regarded and nationally and internationally recognized university. In addition to his leadership role at Chapman, Jim is a longtime author of the annual Chapman Economic Forecast, which has been widely regarded for statistical accuracy. In fact, over the past 18 years, it has been ranked as the most accurate economic forecast in the United States. Jim, thank you for joining us today. I'll turn it over to you for your presentation, and then I will interview you, then open it up to the audience for questions. To our audience members, feel free to use the chat function to communicate with me or post questions or comments. So, Jim, thank you again for joining us today, and it's a pleasure to have you.
Thank you, Jamie. It's a privilege to be with you and to talk about our Chapman Update forecast. We presented that Tuesday, so it's literally hot off the press. And I thought before the Q&A, it might be beneficial if we key up that forecast and allow me to summarize as quickly as I can. And I apologize to the audience out there for going more quickly than I ordinarily would when I present a forecast, because we'll have a considerable amount of time to expand upon some of our forecasts in the Q&A. But I think it would be good to get the lay of the land and see where Chapman is in terms of our overall forecast. So here it is. As I say, we presented it this last Tuesday. We've been at this now for 42 years. It's the longest running forecast in the U.S. And we, as you mentioned, we have a great accuracy record in a comparison between 2004 and 2018 in forecasting real GDP. It turns out that Chapman and UCLA were tied #1 when we compared ourselves to 25 other forecast agencies around the world. So here it is, and I'll start with the U.S. And as you can see here, we're forecasting in the second quarter of 2020 a drop of 35%. There's a lot of confusion out there because all of these different numbers are being bandied about. So I want to make very clear at the onset that when you see these numbers like 35, 40% decreases the second quarter, those decreases are on a compounded annualized basis. So it will take a year-to-year drop, for example, that we see at 9%, and the assumption is on an annualized basis that that's going to continue for 3 more quarters during the course of the year. We're not going to have a repeat of this devastating second quarter. So I'm going to, as much as possible here, talk about year-to-year changes so we don't get that exaggerated impact. Ordinarily, when GDP changes are in a normal range, it doesn't make any difference. But with these extreme changes, we're getting into this exaggeration. More realistically, we saw a drop of 99% in the second quarter. That gives you at least a starting point as to where we are as we approach now our third quarter, which begins July 1. As you can see, COVID-19 is devastating. In the second quarter, we're talking about a drop back of 10% on average. And the Great Recession, I'm using the Great Recession as a comparison. completely different kind of recession caused by different kinds of things, but it's the most recent recession and the most serious recession, most costly recession since we've had in the post-World War II period, or even since the Great Depression. And it gives you an idea that COVID was sharp and deep, much sharper and deeper than the Great Recession, but the Great Recession extended out over 6 quarters. Another big difference, and is the main reason Chapman is a relatively optimistic V-shaped forecast, and that is our analysis of fiscal policy and monetary policy, which has been a faster response and a much more significant response on both the fiscal and monetary policy that we've ever had historically. Just to give you an idea how significant it is, here in COVID, within 5 months, the federal debt increased by $2.3 trillion. Federal debt is a proxy for government spending. It took 2.5 years before the Great Recession approached that, never quite reached it, that level. So the fiscal response much sharper and certainly more significant in dollar terms. Same thing in terms of Federal Reserve Board policy. Measuring that by Federal Reserve Board assets, you see that in COVID-19, within 4 months, the Federal Reserve increased its assets by $2.3 trillion. And after 18 months, year and a half, the Great Recession, it had only gotten to about $1.2 trillion. So not only was it, again, greater, but much faster. And this is interesting, Jamie, in that both federal debt and FRB assets both increased about $2.3 trillion, which points to the fact that the Federal Reserve is greasing the wheels by monetizing the debt, basically buying those bonds that the government has to issue in order to fund, for example, the CARES Act. In terms of payroll jobs at the U.S. level, second quarter, we lost 24 million jobs, sharp increase. But we are forecasting now for the third quarter an increase to 12 million. Notice that that's about a 50% increase in jobs, and another 6 million by the end of the year. When you add the 12 to the 6, that's 18 million, which suggests that we are recovering about 75% of that loss in the second quarter. A real GDP, which dropped, this is the compounded, exaggerated increase that, and I'm showing you this because this is what the NBER looks in gauging and defining when recessions begin and when they end. As you know, about 2 weeks ago, the NBER defined the fact that we are in a recession as of the first quarter of this year. When they look at and date its end and when the recovery began, they will be looking at this quarter-to-quarter compounded rate. We're seeing a big increase in the third quarter, 20% increase. Again, that's that quarter-to-quarter annualized, but you can see here that this is the basis for a V-shaped recovery. On a year-to-year basis is more U-shaped, but nonetheless a recovery from that 10% or so drop. And by mid-next, in 2021, mid-next year, we'll be showing year-to-year positive growth. This is being fueled by the fact that interest rates are lower than they were, for example, during the Great Recession, which extended on over a year and a half. It started at interest rates, long-term rates at 5%. COVID, it started at 2 and dropped to 1, actually right now about 0.7%. And we see it maybe increasing to about 1% by the end of the year. I'll get to that in a second. 90-day or the short-term interest rate, similarly, Great Recession started at 5, ultimately brought it down to essentially 0, but it took a year and a half for that to happen. As you can see, 6 quarters. It happened this time around literally in a couple of weeks, but over 2 quarters, on an average basis, it moved to 0. This might be interesting for your financial types who are always worried about an inverted yield curve and the very consistent relationship between an inverted yield curve and recessions. Before I get into that, let me just point out our forecast. We see the 10-year rate, which is now at around, I think it's 0.69% as, or 0.7 as of the most recent, I think, close yesterday. And we're forecasting maybe 30 basis point, a mild upswing, uptick there. But 90-day T-bill will essentially stay at zero for the rest of this year, and certainly through the first half, at least, of next year. This inverted yield curve is interesting because, as you know, Jamie, when you have this unusual situation when long-term rates fall below short-term rates, it almost always ends up in a recession 2 quarters or 6 months later. That's exactly what happened for a recession. That's just a coincidence. It wasn't because of the inverted yield curve. It was because of COVID-19. But it's interesting that that relationship will hold up again. Total housing starts, because of those low interest rates, means that this recession will be fundamentally different from the Great Recession, which was largely caused and extended out in terms of length because of weak construction, both in commercial and residential housing. In this case, looking at housing, we're seeing a drop of about 50,000 units, from 1.3 million to 1.25 million units. This is in 2020, largely the result of weakness in the first and second quarter. But notice that during the Great Recession, the drawback over a much longer period was 1.5 million. That's 30 times greater than what we experienced or what we are forecasting to experience this time around during the COVID-19 recession. Real GDP, we see a drop last year of 5.3%. It's probably more optimistic than most other projections out there. Nonetheless, that's the steepest drop since the Great Depression, and even greater than any year during the Great Depression. I'd like to talk about my mentor, former Professor Milton Friedman at the University of Chicago, one of the great economists, leading economists of the 20th century. He said that inflation is always and everywhere a monetary phenomenon, believer in monetarism. And what that leads to is some concern on my part over a pickup in inflation, and that may occur as early as next year. And here's the basis for it. The money supply, look at this, incredible. This is not compounded, so it's exaggerated. This is a year-to-year percentage change of 20%. That's the sharpest increase in the money supply since the post-World War II period, when these data were being started being tabulated. Even in Anna Schwartz and Milton Friedman's Monetary History of the United States, going back farther, this is by far the sharpest upswing. This graph, I know it's difficult to deal with, especially in the short term, but you can see here in these two episodes, there is a situation. I'm taking a magnifying glass, and what these two graphs show is that the money supply, here's a double-digit increase to 14% in the early 70s. Prices were initially going down, but then they started increasing again. So it was a lag of around 9 quarters. Prices in the 70s, similar thing. The money M2 increase as a result of very aggressive Federal Reserve Board policy. 7 quarters later, prices started increasing. This also happened in the post-World War II period. The lag was 6 quarters. We did a more extensive analysis. I'm not going to get into detail here, but here's the significant finding, and that is the average relationship between changes in the money supply and its ultimate impact on prices is 9 quarters, more than 2 years, which would suggest, if you believe that, that 9-quarter lag, we might be experiencing a pickup in inflation by mid next year. And that's something maybe we can talk about during the Q&A. Quickly getting into our California forecast update. California job growth since 2019 first quarter has been about 1.5%, fairly stable. It's less than Texas and Florida, more than California, more than New York and Illinois. And California, as you can see, is in the middle of the path. And that's also, on average, about U.S. growth rate. The U.S. in employment job growth is around 1.5%. California used to be higher, but it has since, at least in the last couple of years, is in parity now with the US. Payroll employment dropped sharply during COVID. So that 1.5% growth, which we've had for the last couple of years, you can see the sharp drop of 16.7%. But as in the case of the US, we're forecasting we're going to get half of it back. And by the end of the year, maybe 70% versus 75% in the US. So we have an impact. This 16.7%, by the way, is slightly greater than the drop in the US, which was about 15%. You can see it here in employment numbers that dropped from 17.4 million to 14.5, and then the recovery in the third quarter and the fourth up to 16.6. But notice, in spite of that V-shaped recovery, even in California, by the end of the year, we'll still have 800,000 fewer jobs, and that's still a loss, an unrecovered loss of 4.5%. Point out the fact that many businesses that have gone under and are in bankruptcy and will not return. I want to point out something very important on the employment side and the COVID recession. As you can see, the COVID recession in California, the drop has been largely in leisure and hospitality, a drop, but not as much in construction as we experienced in leisure and hospitality. Same thing is true on the information services and total employment side. In fact, information services didn't lose, the only sector of employment in California that did not lose jobs during the worst of the COVID recession. You can see this difference here is significant. And that's all the more significant when you look at wages. The average wage of all industries in California is $68,000 versus a number that's 2.5 times greater. Information services, the average wage is $187,000. And the same thing on the leisure and hospitality side. Leisure and hospitality, the average wage is $30,000 versus $70,000. So the fact that a lot of these jobs are being lost does not translate into comparable spending decreases on the state product or even the real GDP side, because those jobs are being lost in lower value added sectors of the economy. What are the takeaways from our forecast? Well, we see the COVID-19 recession will be short but deep. The reason it will be short is because of very, very stimulative fiscal and monetary policy. We see recovering of 75% of the jobs by year end. And there's if you believe the monetarism, if you're a believer in the Chicago School and Friedman's rule that inflation is always and everywhere a monetary phenomenon, we may have renewed inflation by mid-2021. If that's the case, you might want to lock into low mortgage rates. Maybe, Jamie, we could talk about the implications of higher inflation later on when we get into the stock market or analyze how the stock market looks as an investment vehicle now. California will benefit from continued strength in information services, which is centered in the Silicon Valley, and the fact that still information services is holding up as a sector will be very, very important to California, and particularly to state coffers in Sacramento. And it suggests in our analysis no need for state tax increase, but maybe we could get into that in more detail during the Q&A, which should start right now.
Great. Well, thank you, Jim. And that's a lot to chew on. And these slides later today for our audience. And feel free to post some questions for us. There's a few that Jim and I were talking about the last couple of days. But so you talk about the tech sector has held up well during the COVID recession. What outlook do you think it will play in the recovery? Is there a balance between kind of resiliency and the fact that people can work at home and they start to figure out that home might not be in California going forward? I mean, what's your view on how we should view that part of the economy?
Well, we looking at information services will certainly be an engine of growth in the state. When I mentioned in the second quarter it was the only sector that did lose employment, it actually, second quarter of 2020, information services increased about 0.5%. Positive, only sector to have positive growth. But we are forecasting that in the third and fourth quarter, it's going to pick up respectively to 3.1% in the third, 3.8% in the fourth. So those will be, it will not only be the fastest growing sector during this recovery, because most of the sectors will simply not be dropping as much as the second quarter. It will be the one sector that will be growing at a reasonable pace. And when you also consider the fact that the salaries, average salaries in those sectors, 2.5 times the national average, certainly it's going to be one of the positive growth engines. But again, largely in the Silicon Valley.
Okay.
Well, but you're talking about, you also alluded to the fact, what about the fact that people who are working at home virtually and kind of liking it for the most part, what are the long run effects of that? That's a whole other story, but maybe we could get into.
Yeah. So, the headlines the last couple of days, there was a UCLA forecast and the Chapman came out the same day, and they're a little different. UCLA headline was "Depression-like crisis." 3 years for GDP to recover, and California's rebound will look like a slow-moving Nike swoosh. With much more pessimistic. Kind of tell us a little bit about, what gave you the confidence about, the recovery and in your forecast, or what surprised you as you prepared this, and what kind of gave you the confidence?
Yeah, well, Jamie, it's the fact that fiscal and monetary policy has been so incredibly extraordinary, aggressive.
Yeah.
And just to give you, to go from the forest to the trees, people hear $3 trillion. It's very difficult to try to figure out what does $3,000 billion mean. If you look at the number of workers, we're the only ones who did this analysis. So let me go through these numbers, because it really brings to bear the significant impact of fiscal policy. And that is, we calculated the lost wages of those furloughed workers, those workers who lost their jobs, perhaps permanently. And we figured out the loss of income during the quarters that, based on our forecast, and that loss is $387 billion. I hate to be so precise, maybe roughly $400 billion. But then we looked at the CARES Act, and just that portion of that $3 trillion package that relates to state unemployment insurance, the unemployment insurance provision, the recovery rebates of $600, $1,200, depending on single or couple, that turns out to be $664 billion. So when you net out the fact that the government is giving to workers, those who've lost their job, $664 billion, to those who've lost $387 billion, that means they're getting $277 billion more on average than they would have. That's on average than they would have if they continued working. So the point here is that while there's been this devastating loss of workers, the fiscal stimulus has been extraordinary. And even more important, generally in the past, when you had the fiscal policy, the Fed didn't do anything, which meant that the government would have to go out, borrow the money to pay for the additional spending, but that borrowing would take away private capital used for construction, investment spending on the part of businesses. But this time around, they were in lockstep. The Fed goes out and buys all this debt. So it didn't come out of, we didn't have to ration private capital, because the Federal Reserve was essentially running the printing press. As I pointed out, they both went up about $2.3 trillion. So that's why we are V-shaped rather than swoosh. And this idea that it's a depression, I think that's a headline. If you really ask UCLA about it, I don't think there's any compare. The Great Depression basically lasted from 1929 to 1941, before the economy really recovered or expanded. That is where GDP was higher than what it was before the recession started. We're nowhere near that. Nobody would say that.
So basically, you would give the Federal Reserve pretty good marks for acting fairly promptly. Maybe our Reserve Chair read, was it Chapter 7 of Schwartz and Friedman's Monetary History of the U.S. about the causes of the Great Depression.
Yeah, well, it gets into the new monetary mode. Maybe we'll get that later. But it talks about right now in the short run, given the situation right now, I have to give Jerry Powell and his colleagues credit for I think, learning from the Great Recession. I think they learned a lot. That you notice those graphs I had, how long it took before they did anything, and that exacerbated the recession and made it longer and more costly than it otherwise would have been.
So we have a number of more traditional investors on the call today, and they look at with some skepticism to the U.S. equities market. You talked about the 10-year bond market, about 70 basis points. What, and what are the implications of that for the equities market? What's your view on that?
Well, I'll give you, I have a colleague here, Fidel Lawandi, who's has, our Bloomberg terminals and our whole real estate center. We write a lot of articles together. We share a financial strategy, and that is, and I think it's backed up by the data. I'm an econometrician, so I'm always looking at data. And that is, I look at the difference between what I call the EP ratio. Everybody knows about the price earnings ratio, which right now, and I like trailing, not future forward earnings. Forward earnings are always way more optimistic, pie in the sky kinds of forecasts. I like trailing. Anyway, the PE is around 21, but what I look at is the inverse. Earnings divided, not P divided by E, but E divided by P. To your audience, right now, the earnings price ratio is 4.6%. What that basically means is that if you get an average return in the stock market, your return on dividends and reinvested profits, which is basically what corporations do when you own stock, that's your return, you get a return on average of 4.6%. Now you compare that to a safe government security like a 10-year bond, and that's 0.7. That means you're essentially getting a premium of 3.9, 400 basis points. Okay, we looked at every bear market, and every recession. Every recession has also occurred at the same time there's a bear market. We haven't had a bear market yet, but every recession is accompanied by a bear market, except for one. You know what was different in that one recession? And we didn't get a bear market. It's the same thing we have today. And that is that the EP ratio was higher than the return on a long-term bond. Basically with a, to get to the basis of this theory, when you get a premium by investing in the stock market of 400 basis points, that's a pretty good incentive for those equity investors to take the added risk. Okay.
So let's talk, how should one think about inflation? A business owner or investor, it looks like we should expect, some inflationary pressure second half of next year. What's different this time around in terms of the deflationary elements of technology and globalization versus the inflationary pressures of monetary policy? How should one? What are some of the considerations one should have?
Well, we're kind of out on a limb in terms of we're monetarists, and our Chapman econometric model buttresses our belief in monetarism because of this lead-lag relationship between M2 and prices. So that's mid next year that we think that there may be a pickup. If that happens, the lessons would be maybe you want to lock into long-term interest rates now that are around mortgage rates at 3% if you can, or even other borrowing or corporate borrowing. This might be the time to access those capital markets before interest rates begin increasing again. Always remember that inflation, stock market is a great hedge against inflation. So that would also suggest that equity investment, and may explain why the stock market is doing well in spite of this deep precipitous drop, COVID-related drop in the second quarter. The other thing is that inflation most inflation measures are probably exaggerated, Jamie. It gets to what you just said about technology. Measuring prices is a very difficult science. And many economists spend their entire careers trying to figure it out. The problem is trying to figure out how prices have increased in light of the fact that we're dealing with completely different kinds of products, services, delivery systems, e-commerce than we've ever had before. So I think the inflation measures we have now are probably 1% higher than what they should be. And right now, I think part of the aggressiveness on the part of the Federal Reserve is that they're not too concerned about that potential for an inflationary pickup. I personally think they'd like a little inflation, given the deflation that we've had, especially if you consider the fact that prices have underestimated the price impact. Deflation has been a greater problem than the numbers would suggest. So I think the Fed would like to see a little pickup there.
Yeah. Well, your examples were after the war, and 46, and then the 70s after the Vietnam War, where being a debtor, having inflation was a good thing, because it makes the cost of your debt go down over time. So we're certainly
exactly. So that's another, especially given the huge increase in debt at the federal level. That's a great way to pay it off.
I could just, when I was listening to you give this presentation again, I heard you the other day, I watched some tape again today. It seems like your voice really, a lot of enthusiasm when you talked about the coordinated or simultaneous fiscal monetary policy and unprecedented in its quickness. They move very quickly. Can you kind of break down for us a little bit of where, the 2 trillion of fiscal stimulus and the 2 trillion of monetary stimulus is going, and give us some views on what you think has really worked? Your comments about the 664 billion going to the workforce that was missing 400 billion wages was very enlightening. Are there any other comments you can give about, kind of, where this $4 trillion has gone and what the impact will be?
Yeah. Most of it is going to support unemployment compensation and compensation to those workers who've been furloughed. Also, the PPP payroll protection program is also, that's about, I think, 300 billion of the 3 trillion. And there's a lot, and I would take maybe 500 of that as reserved for state, and 500 billion, half a billion for state and local governments.
Okay.
So that would be kind of a breakdown, but just the amount that's going into the unemployment, various unemployment compensation programs, that's almost 700 billion, 500 state and local areas. You have the PPP program, and then all kinds of other things. By the way, there was a report out today, hot news, that $1.5 billion was paid out in the recovery rebates to dead people. So to try to figure that out, but that's typical.
$1.5 billion to dead people.
It's probably a low amount given
some states they still vote, Jim.
You're going to be hearing for years and years later. Whenever you deal with something that's 3 trillion, you're going to find that a lot of that money is not going where it was intended. But I'm going to tell you that one problem in all this is that that the Federal Reserve Board, which has monetized it and has bought up those bonds for the CARES Act. In addition to all that, the Federal Reserve Board is now not only buying U.S. bonds, but is now buying corporate bonds, commercial paper. In fact, they've even have agreements in place with PIMCO, BlackRock to be their agents in buying bonds, corporate bonds. And that the BlackRock and PIMCO to be used in buying commercial paper. But what they're not doing is supporting small business.
Yeah.
And that's been the most devastating impact of COVID, has been on small businesses, particularly minority-owned businesses.
Let's talk about that. I think 41% of the Black-owned businesses in America are shut down. 70% of them don't have Black-owned businesses do not have a banking relationship. If you take the 5,000 banks in America, only 21 are Black-owned. Of the 5,000 other banks, they have $20 trillion in assets. The 21 banks that are owned by black-owned banks have $5 billion in assets. So there's a real disparity within the financial system, which has been called to attention through the most recent protest and awareness on the issues. And there's a significant opportunity, challenge, and as well as an opportunity, as you well know, to kind of grow the economy of the black-owned businesses. But how can one think about increasing liquidity to Main Street businesses, and particularly businesses owned by blacks or other people of color or other minorities in the U.S.? What are some of your thoughts you've seen or best thinking you've seen on that subject?
That's a very, very important subject, and something the Federal Reserve in particular needs to give attention to. When you talk about the 41% of African-American owned businesses going bankrupt, for white owned businesses, it was 17%. So more than double the rate of loss. And part of that is because they don't have the infrastructure in terms of banking in their communities, the lack of community banks and the lack of the larger banks serving those customers with branches that they don't have in these communities. So it's a significant problem, but there are things that can be done about that. I really believe, and I've heard numbers bandied about that, that the Federal Reserve Board can really fix this, but it would cost another $1 trillion over a 10-year period. So you're talking about 300 billion, a lower amount. 300 billion over, I'm sorry, $1 trillion over a 10-year period, which you're talking about 100 billion every year. So it's manageable. But what the Fed has to do is, in addition to supporting larger businesses, which is what they're doing with supporting corporate bonds, buying bonds of all credit levels, commercial paper, again, that's for larger businesses. Very little has been done for small business. And that's where most of the losses are taking place. So what the Fed can do is the same thing it's doing for big business. And here's how the big business model works. If a corporation is having problems, it can go to its bank. It'll have a large banking relationship, whereas many minority businesses will not. But it'll go to its bank and, let's say, borrow $1 million. The bank now can sell 95% of that, 950,000 of that $1 million to the Federal Reserve. The Federal will be on the Federal Reserve Board balance sheet. And the bank then will only be out 50,000 and can then use its capital to lend to others. So if the Fed does the same thing with small businesses, that's where the fuel is needed right now. In other words, if these small businesses go to their banks, and then the banks can then sell these essentially small business loans to the Fed, that will increase liquidity. But the other problem is that these small businesses don't have the minority-owned banks and the banks in their community to process these loans. So that means that these banks need to be supported, or larger banks need to create branch relationships to service these businesses. It's a major problem, but it's a fixable problem.
Yeah, it's a fixable problem, and now there's really starting to be some awareness to it. These community banks have the relationships in those neighborhoods with the businessmen, and properly capitalized, and with
by the way,
technology, they can make a huge difference, I think. So
on that point, it was proven out here with the CARES Act. Those small businesses that had relationships with minority-owned banks, community banks, were able to process the CARES Act funding and get capital when they needed it to support their businesses. But those that didn't have access to those, who had to go to larger banks, they didn't get them. The larger
the ones that worked
longer delays, they're still waiting.
Yeah, the ones that worked with the small tech banks, that with non-branch banks that really partnered with the community banks and delivered the financing. But again, 70% of the black-owned businesses in America have less than 4 employees. So these are the definition of small businesses. So let's kind of change the pace a little bit and talk about a lot of debt in America, and there's been you referenced it, new monetary theory. What is it? What aspect of it has merit, and what aspect of it is questionable that might, undermine our long-term, economic strength as a country?
Well, those of you who understood what I just explained relating to the old monetary theory, the Friedmanite monetary theory, is essentially there's a relationship, that inflation is always and everywhere a monetary phenomenon, that changes in the money supply will ultimately rear its head in terms of inflation with a long and variable lag. Okay, the new monetary theory has been bandied about. There's really not all that much difference. It really comes down to a difference between the short run and long run. A new monetarist would say, old monitors give far too much attention to the deficit. You shouldn't worry about the deficit. That's not the number you need to look at. New monitors would say is you look at the productive capital of a nation and how much a nation can produce. And if the US is not producing what it is capable of producing, like right now, because of COVID, real GDP is far lower than what we could be producing at full employment. So in the short run, the monitors should say, don't worry about the deficit and don't worry about that monetary creation being orchestrated by the Federal Reserve Board because of this difference between the amount that can be produced and at that point in time, what is being produced. And what monitors would agree with that. I agree with that. I'm a monitor, so I applaud what the Federal Reserve Board is doing now. But what I'm also looking at is the long run and pointing out that once you have that liquidity in the system, it's not easy to get it back. as we've seen after QE1, QE2, QE3, after the Fed increased its balance sheet by more than 100%, it's hard to reduce that. And because of that, there could be the inflationary pressure in the future when we're at full productive capacity again. So when we get to that point in the economy where we're fully employed and we have all of that capital out there, that money that has been created and deposits in banking systems and deposits in Federal Reserve Board, all of this liquidity can then translate into excessive spending given what the economy is capable of producing, and that's when you have inflation. Okay. I guess the new monitors would say, okay, when that happens, then pull it back, but that's tough to do.
Yeah, once you get used to something, it's hard to change behavior back. A whole wide range of questions related to housing. I'll give you a buffet to answer from, Jim. Housing and the impact likely. Second wave and the impact that would have on the economy, particularly consumer behavior. And the election, what sort of tax alternatives will be on the table during the upcoming election. So which of those would you like to answer?
Well, maybe we could talk initially about housing and then get into the election. We have a forecast model on the election, but on the housing side, the reason we're as optimistic as we are is that housing affordability nationally in the state and even in Orange County. I like to look at housing at local levels because every local market is different. But the over-encompassing truth here is that housing affordability has increased. Median family income has been increasing up until COVID. You also have a situation where mortgage rates have decreased significantly, which is another aspect. And housing appreciation has been lower than what it has been in the past. When you put all these things together, housing affordability, even in an overpriced area like Orange County, housing affordability has increased from 65 to 80%, which means that median family income is now 80% of that necessary to acquire a median price home. So with that increase in affordability and traditional mortgage rates being at 3%, we see housing recovering. On the tax side in the future, our presidential forecast model, which is based simply on economic variables and is very, very accurate. Of the last 16 elections, it has correctly called 15 of the last 16 presidential elections, only one missed call.
Which one did it get wrong?
That was the Nixon JFK election in 1960. And I claim that's an aberration because
Yeah,
if you take the allegations of voter fraud in Mayor Daley's Illinois and
yeah,
LBJ's Texas, and you take those fraud figures, it would translate not to a electoral college victory for Nixon, but a popular vote victory because there's very narrow margin. But that was the only one. Other than that, it's called every popular vote victor. This time around, plugging in the numbers that we have in our more optimistic Chapman forecast than other forecasts out there, it's calling for a fairly big loss on the part of Trump in the popular vote, or a Biden victory of 10%.
wow,
Which translates then getting into taxes. If that holds up, if that happens, it will depend very much on what happens to the Senate, because the
yeah,
president can't do anything alone. But if the victory is that much, of 10%, I think that would also point, because it only takes 3 positions on the Senate side to change that. You'd also have, Democrats would also have control of the House, Senate, and the presidency, not by an overwhelming margin, but control, which would suggest that I think you're talking about tax increases again, probably. I'm not sure we would go back to corporate tax rates of 35% again, but maybe 28%, maybe get half of that back, and it'll be soak the rich mentality again. I think that's fairly certain.
yeah. Okay, something to look forward to.
Yeah.
Anyway, so what was the biggest surprise to you when you pulled together this forecast? And if you had to go back and change one thing in it, after making, a dozen presentations like this or this week, what would the one thing you'd change?
So, well, the surprise I have, given that we've been tracking these things for so many years and recessions for so many years, this is the first time that you've had such a quick and quick response, but the kind of response in terms of fiscal and monetary policy, and almost as if it were coordinated. I don't think it was, but in a sense, it turned out to be that the Fed really greased the wheels on this enormous fiscal response on the part of the government. So that was really a surprise. I knew it would happen eventually, and maybe like a Great Recession, but not as quickly as it did. I think the most significant uncertainty right now, it's a big elephant in the room, is that we're optimistic, but if we have renewed shutdown orders or another, not just another wave, but not a surge, but another COVID-19 wave in the fall, as we did during the Spanish flu of 1918. Very sad. 1918, it was a spring, it hit in the spring, but it came back in the fall even more deadly and more significant. My concern is if that happens, all bets are off. It's a different ballgame.
Yeah. Well, you've seen quite a bit of adaptation, so I'll just kind of wrap up. Today's Wall Street Journal has an article about how universities are adapting to the new normal, public health normal, and it references Chapman University several times and pays credit to the leadership team there. Obviously your legacy and carried on by President Strupa. I look at that and I think about what works in America. Is a combination of technology, which your new School of Engineering and Science that you built, business, your business school, and which part of the economic forecast is part of, and the School of Communications is, and then the creative side, which you have with your film school, your dance school, your art school, and that combination of creativity, innovation, technology is really what drives our economy, and it seems to be what's driving Chapman. So kind of sitting there as a longtime educator, who's taken a school, some local promise into international renown, what would your advice be to sort of, academic leaders or business leaders who are on the board of different universities about how to kind of, navigate the new normal? And it seems like every crisis creates an opportunity. What the final word on kind of what's the opportunity you see coming out of this?
Well, universities and colleges are certainly under pressure, and I think that Wall Street Journal article points to the fact that Chapman is really at the frontier of how to do it right.
Yeah.
We're still challenged, but our students have access to computers and broadband, and then made it easier. The tragedy is we don't have that in K through 12 education. Those are the feeder schools, so those future students are going to be in our creative programs, our science programs, business programs at Chapman. If there's any one pitch I can make, for example, if I were running for president, I was at the top of my platform would be what this government needs to do. What we need to do collectively as a community is do whatever we can to get broadband throughout the nation, in every community, rural as well as urban. So we don't have this problem where those kids that don't have access to a computer in their homes or access to the internet, and as a result, they're not receiving education as they're in lockdown mode. That has to change. India's done it for, a population of 1 billion people. Why can't the US do it as well? We need to move aggressively on that front as soon as possible so we can translate the technological achievements and get them to the point where we can better deal with the COVID-19, not only now, but the COVID-19s of the future. And there will be these in the future as well. So that's my I guess if I get on the soapbox, that's my soapbox spiel. By the way, before I end, I want to thank you, Jamie. People may not know this. They know you're a managing partner of a distinguished VC company. We're going to be talking about that in my interview with you later on today for Chapman Connect Show. But I want to thank you in particular for all you've done to expand our entrepreneurship program at Chapman, which is near and dear to my heart. More and more of our students are interested in starting their own businesses and being on the creative side of things and being on the innovative frontier. And that's where job creation is. But you help spearhead that program at Chapman. So thank you for your generosity, your philanthropy, but also your leadership.
You're welcome, Jim. It's been my honor to work with you and Chapman. And thank you so much for your perspectives today. Been very interesting for all of us, and it's just a great national asset you are, and thank you for taking an hour of your time to spend it with us and share your insights with us. So Jim, thank you, and we'll be catching you.
Thank you. It was a lot of fun. It was a privilege for me. Take care.
Thank you. Bye-bye.